When you're faced with these decisions as an investor where two things are almost the same, but you're on an investment committee, Peter, so what do you do in this situation?
My first thought is
Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the Solactive GBS Developed Markets ex-Oz Large and Mid Cap Index. It's quite a mouthful, which some investors may know is tracked by Betashare's BGBL, which is a competitor to Vanguard's VGS, and the index is quite similar in performance to the MSCI World ex-Australia Index. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts we'd like investors to better understand risk so they can make informed decisions. So periodic performance. For comparison, we've used a competitor index, and except for inception for Solactive, MSCI World ex-Australia is ahead in all time periods, but there's nothing there that says pick one over the other. And when you're looking at the products that track these indices, it's probably going to come down to things like fees. Betashares is cheaper. There's other things like securities lending. I believe Betashares samples the index, which Vanguard is full replication of the index, but I would guess the gap in the future will be so narrow between them. They're both good products. You just, as an investor, pick one and move on.
100% correct. The differences in the results there are so insignificant, it just doesn't matter. To me, your point that investors, if they're looking for diversification, picking both of these would be a complete waste of time, because you're basically having exactly the same thing with a different label on it. You know, the differences in performance at any point along the way don't even run to 0.1%.
And growth of wealth, and to highlight, pick one and move on. The difference is a cent after starting with $1 after nearly 20 years.
Yeah, proof of the earlier comments. They are so similar, there is nothing to separate them bar that 1 cent over 20 years. It's not worth thinking about. I'd hope investors would have more to do with their time than think about the differences between these two.
And sector comparison, I've just slid this in there because they're not quite the same in construction, but if you're looking to see whether there's some extra bias, MSCI being on the left towards a sector, I mean, this gets back to industry classification. I think we've mentioned in the past by indexes. I mean, nothing's standard between any of them. So in one aspect, one says IT is 24% with communication 8%, while the other one says technology is 30%, but communication services is 2%, and just adds up to the same thing, just termed differently.
Yeah, and look, there might be small variance in different sectors and individual companies between them, but in aggregate, they're so very similar. When you look at, number one and number two on each side are reversed, but they're the same. Number three and number four are the same on both sides of the chart. 5 and 6 and 7 are the same three stocks. It's, is it the bone, the beige, the off-white? It's almost, the same thing.
And range of returns, this would almost be the same as MSCI World if we kept it to the same time period.
Absolutely. That looks exactly like the MSCI World. To me, this is a non-diversifying choice.
And rolling annual return, same thing, pretty strong returns, whether you use a fund tracking MSCI World ex-Australia or the Solactive ex-Australia large mid, they just played the large cap role in your portfolio. You should not pull your hair out over the decision.
Absolutely not. There's absolutely nothing wrong with this as a choice, just the same as there's nothing wrong with the MSCI index as a choice. To me, don't get hung up on the semantics, don't get hung up on the minutiae. As you said earlier, pick one, move on. There's better things to do in life than agonise over the differences between these.
In largest fall in time and recovery, just cutting out the first half of the 2000s, but a very similar experience to MSCI World ex-Australia. Didn't dodge anything with Solactive because it's a function of holding a lot of the same companies in similar percentages.
Yep. If we just looked at the MSCI chart over the same period of time, I bet it would look almost identical.
Yeah, pretty much a mirror. And risk return or efficient frontier and very similar risk return overlapping there.
I'll just point to investors, you need to have very good eyesight to see any difference between them in this chart. You know, it is just the same thing.
So when you're faced with these decisions as an investor where two things are almost the same, you're on an investment committee, Peter. So what do you do in this situation?
My first thought is, who's the provider? Start with how reliable a provider you're talking about. I would rather support a long-term stable provider with a really solid business that you know is going to deliver. That's the first priority. Assuming that the long-term, robust, reliable provider and the newer, later to the table provider are trying to deliver the same outcome, trying to build the same widget, so to speak. I'd look for that stability first and accept that I'm making the decision about the type of portfolio I want. In this case, I'm really saying, well, I'm really getting the MSCI World ex-Australia Index or something so close to it, it doesn't matter. Find a reliable provider to do that. And then forget about the others.
I mean, sometimes you'll see people say, oh, well, how can I trust this provider or should I put 50% into this one because what if this one goes bust and that one saves me? What do you say to people who like get bogged down in the concerns about a fund manager going busto?
Important to remember that, yes, a funds management business can fail. There's no doubt that can happen. The bigger, reliable providers, particularly in the index space and the quasi-index space, they are incredibly sound businesses. But the underlying managed investments are not the management company. They're asset pools that are the property of the underlying investors. So this business could go broke, but it doesn't mean the actual index fund or the quasi-index fund is actually adversely impacted. So to me, with the reliable providers, it's been such a rare event, but B, don't bother about it because the two things are actually quite divorced when it comes to the failure of the business. Pretty much every managed fund, ETF pool or the like also has, of course, a separate custodian that holds the ownership of the assets. Again, it's not the trading business. So I don't believe, provided you've used reliable and robust providers in the first instance, you shouldn't be worried too much about that at all.
Yep, really good points. And finally, sources and descriptions of data. Thanks for your time.